the US economy has been holding in really well. Obviously, the perception of a massive trade war with China and supply chains coming to a complete halt is what took the markets down. But if you look at the forward earnings, they haven't really moved. They've actually held really well. So the markets are recalibrated and went back up. Now you can argue that the valuation multiple was, 10-15% discount. Now it's looking fairly valued. This year, the equity markets will be range bound. We have the downside support between healthy corporate balance sheets. The labor market, as you said, is very strong. We saw NFPs of plus 149,000 last week, and the unemployment rate is 4.1%. But on the upside, we're not seeing any earnings growing much above what's already priced in. So markets in a bit of a range bound. Having said that, there's a lot of pressure to Fed to cut rates, and the market itself in the belief that the Trump's going to get his way. But there is no reason for the Fed to cut rates. So the perception of liquidity is supporting equity markets right now, but they're not going to be making newer highs because earnings are not going to grow anymore. They're plateauing. So we're not bearish, but we are right now cautiously optimistic because a lot of the good has been priced in. But the US economy is holding right in. The whole trade of US exceptionalism is still quite alive and well. The large cap companies are doing well. You've seen the capex numbers from the big tech companies, spending on data and AI. So those things are doing well, but the smaller mid cap companies are still not doing well because I think debt and interest rates are a big concern. Refinancing this year is going to be a huge concern as rates are 4.5%. A lot of company US debt needs to be refinanced this year, and the yields are already too high, and the Fed's not cutting rates. So I think that's much more important, which is why the markets are range bound.